wanted to take some time today to explain something called the trust fund recovery penalty. It's kind of a silly name because it's actually not a penalty at all. It represents unpaid payroll taxes that an employer is responsible to hold in trust for the U.S. government. To make matters worse, it used to be called the 100% penalty, which led people to believe that there was a penalty of 100% of the tax penalty and interest owed on top of what they owed in terms of payroll taxes. But that's not really the case. So let's take a look here on the board and I'll explain it a little bit better. Okay, so we have the trust fund recovery penalty, TFRP for short. And what we have here is what I call the payroll tax pie. It's the only way that I could ever figure out how to explain this to people in simple, concise language that they would understand. So as you can see here, I can't draw circles very well. And number two, that there is a larger half of this pie. And the larger half of this pie represents the employee share of payroll taxes. And over here we have the employer. And I'm well aware that I didn't spell those things right. But so what we have in each half is we have half of FICA, half of Medicare, and over here you have the FUTA, the federal unemployment tax. And over here you have half of FICA, half of Medicare, and you have the federal income tax. So here's what this means is you understand when you get your paycheck, there's this large chunk that's taken out of that. Well, the employee has to pay, half of the FICA, half of the Medicare, and then they have federal income tax automatically withheld from their paycheck. And that's something that the employer is supposed to do for the benefit of the U.S. government and the employee. So what we have over here is this larger half is what we call the trust fund portion. That larger half is called the trust fund portion. Again, it's because the government or the employer is supposed to hold that in trust on behalf of the employee and the United States government. Over here you have the non-trust fund portion. And it's the smaller half. And if I had to guesstimate in a typical case what the percentages are, I'd say this over here is probably like 65%, and this over here is like 35%. So if an employer pays net payroll, which means they just pay the employees what they're going to get in their pocket in their paycheck, and doesn't submit the payroll taxes, what will eventually happen is the U.S. government will come after them for the trust fund portion. They'll assess that against a responsible party. A responsible party is someone who's willful and knowing that the payroll taxes weren't getting paid. So as you can imagine, there are going to be more than one responsible person. Typically there's one, it's the principal, it's the boss, it's the owner if it's a small business. But sometimes in a little bit larger companies, there can be more than one responsible person. So what happens is there's actually an interview called a 4180 interview with a revenue officer, and they're going to go through and determine who was knowing and willful and assess them the trust fund recovery penalty, which represents the trust fund portion of the tax. Now that responsible person does not have to pay the non-trust fund portion. I guess that's the good news in this scenario, but none of those is really good news. Okay? So furthermore, if the company makes payments towards the overall payroll tax pie, just makes voluntary payments trying to get back on their feet, the government has the ability to apply those payments in the best interest of the government. And where do you think they apply those? They apply them over here. Because they want to go ahead and hold the responsible people as for this larger portion if and when the trust fund recovery penalty is assessed. So hopefully that's not confusing. If the government if you just send in a voluntary payment, the government's going to apply it over here. That's not in your best interest, but you do have the right to, if you're going to make a voluntary payment, this is not an installment agreement payment, but a voluntary payment before the stuff hits the fan, then you're going to want to go ahead and designate that payment and have it applied over here, because you kind of get 2 for 1. You get some of the money, you get that same money taken off the trust fund portion, and you get the same money taken off the corporation's overall liability. So hopefully that's clear as mud. If you have questions about this or really anything else that have to do with IRS problems, please give us a call, 888-438-6474, or visit our website at getirshelpnow.com.